In this next session, we are going to analyze the significant increase in securitization volumes reaching 8.8 billion USD and its implication for investment strategies. Delve into integration challenges and innovative solutions in managing the life cycle from origination to NPA in co-lending arrangements. Discover diverse models of co-lending such as CLM1 and CLM2 and the imperative need for distinct technology and engagement approaches. Ladies and gentlemen, on a panel discussion on co-lending and securitization, getting ready for 10x growth, banks, NBFCs, and enterprise fintechs bridging the credit gap. We have with us, ladies and gentlemen, let's give a warm round of applause as we call on stage Narendranath Mishra, Head Retail and Agri Loans, DCB Bank, Nilesh Ghuge, Chief Executive Officer, Western Capital Advisors, Rama Raju, Director, Pennant Technologies, Kushal Rastogi, Founder and CEO, Knight Fintech, Mathew Chacko, Partner, Spice Route Legal. Let's hear it for them, ladies and gentlemen.
Good afternoon, everyone, and welcome to this session. I usually introduce myself, for those who don't know me, as the ball man in a suit. And I'm looking around the audience and I can see lots of friends with the same hairstyle and the clothes. Says a lot about gender diversity in the industry, but anyway. Without much ado, let me quickly go to introducing myself. My name's Mathew Chacko. I'm a lawyer with about 20 odd years of experience, with a lot of work experience in the interplay between financial sector regulations and tech. That said, my panelists told me very clearly that you lawyers talk too much. So please keep quiet. You only take 1/10 of the time and let them talk because they're the industry leaders. So with that, perhaps we'll do a round of introductions. Nilesh, do you want to go?
Thanks, Matthew. And good afternoon to everybody. And thanks to Digital Fifth for a fantastic platform, okay, and inviting all of us here. I think it's an amazing platform to share our views and I feel privileged to be here. So a quick background, I am Nilesh Ghuge. I head Western Capital Advisors. It's a small NBFC. Been a banker for almost around more than 2 decades and have been associated with securitization and co-lending since the inception of co-lending, I can say, in the initial phase pre-2018, where the guidelines were not set. So that's all. Thanks from my side, and look forward to have a very interactive session with all of you. Thanks.
So for those in the industry, when he said small, he didn't mean small like we understand it.
Good afternoon. This is Narendranath Mishra. So currently I am heading Retail and Agri Loan in DCB Bank. So overall I have 2 decades of experience in banking and financial service sector and more towards the retail and agri side. And that includes both self-origination, securitization and co-lending. Thank you.
Thank you all for joining for the session. Thanks to Digital Fifth team for giving us this opportunity to talk here. Myself, Rama Raju. So I head Pennant Technologies. I come with 20 plus years experience in the banking, building technology platforms. And currently we are at Pennant Technologies. We have a lending platform that we work with a couple of large NBFCs and banks in the country. So yeah, thank you once again.
Hello. Good afternoon, everyone. It's truly a privilege to be part of this panel. It's an honor to be here. Myself, Kushal, I'm a founder and CEO of Knight Fintech. We are essentially a new age banking infrastructure company, largely focused on co-lending, lending, and treasury. It's been a great journey over the last 4.5 years working here and leading the team at Knight. We are like already a pioneer for the co-lending segment, working with close to 12 odd banks and 45 odd NBFCs, and have been right from the initial RBS circular, have been part of the overall co-lending journey. Thank you so much.
So great. So we've got 2 people on the lending side and 2 people on the tech side. So hopefully we'll see different perspectives on this question. But before we begin, let's take a good sense check on the state of the market. Now, anybody who's read the newspaper knows that there has been an uptick. But let's go one by one through our panelists and figure out what their view on the uptick is, why there has been an uptick, and as a lawyer, I'm particularly interested in knowing whether the regulator has helped in driving the uptick. Nilesh?
Thanks, Matthew. I think talking of the market, let me put it into two aspects. Here we are talking of securitization as well as co-lending. So we all know securitization, I think, is a matured product. It is seen lots of cycles. So there's lots of data which is available. I think we talk of 2,30,000 crore of securitization market, and this year it is going to reach all-time high. So obviously there has been an uptick, and there have been multiple factors why this uptick is seen. Coming to co-lending, it's a very, very nascent market, I would say. I think we still don't have lots of organized data coming out, and hence the market size appears very small. I think some statistics, 2022 we saw 5,000 crore of co-lending. 23 it went to 25,000 crore, so 4 times, 5 times jump. Okay. 24, let's wait. I am sure these numbers again will be multiple in terms of excess, so it is not going to be a percentage growth. It will be 3 times, 4 times growth. Having said this, securitization seeing a larger pie, I personally believe co-lending, whatever numbers are displayed, it's a much, much bigger opportunity even today. Because there are lots of BC partnerships which are running around, which might not get included. There are many NBFC to NBFC partnership which might or might not be counted in the 25,000 crore. I am sure this will grow manifold as we come, and very soon I will not be surprised if co-lending goes beyond securitization. So that's about the market uptick. Naren, your view?
See, the securitization market is more or less established, as Nilesh rightly said. So typically a credit cycle takes a decade to actually stabilize. Because unless you see like demonetization, COVID problems and how the portfolio is behaving, the market or the lenders will not fully trust. I think co-lending is just a 5-year-old product. So probably once it goes to the next 5 years and how the partners are behaving in difficult situation. Because when a COVID comes or when a demonetization comes, then it impacts the lending and the lending tap reduces. So at that time, how the partners are collaborating with them and how they're able to collect the past portfolio, that would show that whether co-lending will be bigger than securitization. To me, it looks like at least for next 5 years, securitization will be well above co-lending because the norms are quite well defined in securitization, unlike co-lending, which is evolving. And it has a proven track record, rating is there of each pool, and there are multiple sets of investors, and that is far more uncomplicated than co-lending. Thank you.
Thanks, Nilesh and Naren. Now let's go to the techies. You've heard the statement from the buyers.
Right.
They're saying that there's been growth and there's a huge growth coming up. So how will tech respond to that? Where do you see the business opportunity? And how will things change for you, both Raju and Kushal?
Yeah, thank you. So I'll not talk about the business. I think from a business perspective, we as a vendors or we as a tech providers, we are seeing definitely uptick, But there have been a lot of inquiries than actually the businesses. I think that's what I like within our existing customers also. We've seen that there's so much of traction, but I think the closure of the deals is a little slower than what was expected about 2 years back. That's what, as a tech providers, we see our customers doing it. But I think in terms of regulation, yes, we have got, I think, good amount of data points that are there. One thing that maybe 4 years back, 5 years back, there were tech challenges definitely because the amount of data availability, the data interportability between the parties, right? Because that's one of the important thing again. So because one NBFC operates in a different way, the bank operates in a different way. So I think right now the technology platforms are ready to make that interportability between the data points from one bank to another bank. or one organization to another organization. I think that's something that is happening, or it already happened in the last few months, which is actually enabling the entire co-lending business to grow. So that's what I see from a tech side. Second, again, co-lending was more between a bank to NBFC. That was the kind of structure that we've seen in the past, but that model has changed in last few months. And the co-lending models are happening between the NBFCs also. I think that will basically create a larger pie in the market. These are the two aspects that I just want to add to the discussion points.
I think all the panelists made very great points. What we see is that there are different levers which are driving co-lending vis-a-vis securitization, because as securitization, as panelists mentioned, it's already something which is a slightly matured market. In terms of the upticks, and if we talk about the business, back in the month of, let's say October, November 22, something we were seeing a business of maybe around 40-50 crores a month, which has now scaled to roughly 2,000-3,000 crores a month, right? So we have seen the growth into the co-lending space across CLM1, CLM2 has gone exponentially, where the number of disbursements, number of cases have been nearly doubling month on month on the platform. So definitely we're seeing there is an uptake happening. There is a lot of regulatory clarity which has come over a period of time, including for an NBFC where you have the FLDG and all those guidelines which have got a lot more clearer. And I think the overall regulatory environment is conducive, and that is driving the co-lending movement. Yeah.
Before we move on, let's stick to the techies. Obviously, disbursement numbers have gone up. There's no doubt about that. But do you see new entrants, hitherto, non-customers, who are suddenly looking at co-lend? I'm presuming securitization is a mature market. The players are well established. Do you see new lenders rushing to co-lending? Or is it the same, we know the suspects who are, in the market? What do you see from your end?
Go ahead. So what we are seeing is, if you look at the co-lending as a model and how industry, so there are some very fundamental benefits in co-lending, right? Because it's adding value to the entire value chain, right from the customer to the originator and the lender, right? So better customer service, cheaper rates, all of those things. And also the government has been facilitating in terms of, we'll talk about that maybe later, in terms of how the economy has to grow and actually serving the Bharat, which is the underserved and the entire angle of the priority sector lending, right? So which is essentially 40% of the banking, right? So there are a lot of drivers which are driving this, and there are a lot of benefits out there. So, and especially if you look at in terms of passing the interest benefits and certain things to the borrower, which is again part which co-lending can handle. So as few players start to do co-lending and they are able to do better service to customer, they are able to lend at a cheaper rate, because at least 150 to 200 basis points of delta gets generated in terms of the cost of capital for the originator or for the smaller lender. So all of those things will drive the other originators and other fintechs and NBFCs to get into the co-lending, because that is the biggest driver. So as more and more players move towards that, it that is the kind of a circle. It's a positive flywheel which brings the ecosystem together on the co-lending.
Absolutely. Raju, your perspective?
Yeah, so from my side, I feel the co-lending as a model, it has to be some vintage between the organizations. So I feel that the new entrants want to do the co-lending, but someone just started business and in 3 months they just want to get into a co-lending arrangement with a bank. I don't think that's an easy part. So there has to be some vintage, there has to be some success factors as a lenders they would have created, and I think that's where the partnership started working. This is what we have seen with our existing customers, where there is a vintage between the two parties, then there is an amount of risk data that is available, there are data points that are available about the organization, the kind of customers they're able to source. So we see that it is going to happen between more established players, or there is some bit of vintage, rather than completely fresh player coming in and saying, I want to start, do a co-lending. It may be a little tough, but maybe from investor perspective, someone has got a big book and they just want to come to the market, grow their book, and there are players, there are established players, they want to come and source the leads for them. I think that's where the models are evolving.
Great. So before we go in deeper into the technicalities of co-lending, obviously the topic of the day, not securitization, but let me ask about the one market player that is not on this panel, the startups and the scale-ups, right? Do you see, and your perspective, of course, is running larger organizations, a little removed from them, but do you think from a regulatory market trend perspective, more startups will now get themselves regulated as recognized lenders? And do you see them playing a role in this? I know the large scale-ups are already there, but do you see even the smaller ones slowly trying to get registered? Because in this market where co-lending becomes very popular, to do without co-lending becomes, in my perspective, very difficult. So what do you think on market trends, Nilesh and Naren?
So, as Raju told, he actually told the lender perspective. So typically, when co-lending is just an evolving business, so most financiers will be very comfortable with an established player. So if a new player who is just 1 year old or 2 year old wants to come in, most financiers will not be willing to do the co-lending because their portfolio has not matured. Because once the portfolio matures, then the trust comes in. So an NBFC which has gone through a credit cycle, which I was telling previously, like credit cycle means some external event and how they have handled it. And if they have shown that, then banks will be more comfortable. But as we grow, maybe another 3 years, 4 years from now, even for a 1 year old company also, the banks or the NBFCs might be willing to do co-lending together. So today, I think that is little far-fetched. Today, people are mostly going with experienced NBFCs for the partnership.
You've heard it from the horse's mouth. Nilesh, what do you think?
Though I'm getting securitization, though you said you keep it out, but I think it's relevant. Okay. Securitization has seen seasoning, and we have a third-party buyout today, which might be a rating agency who gives me a PTC paper rating or a LEI, which as a lender, be it a bank or be it a big NBFC, we derive comfort out of that. Going to what Raju mentioned, today co-lending is largely happening with players where you have a relationship. So you know the characteristics of the partner. It would have started through a term lending and then it would have gone to a securitization transaction and then you eventually get into co-lending. This is where the cycle is, I think, as co-lending evolves and we get some bit of maturity in the model and some bit of standardization in terms of might be a third party coming and vetting it. I think that is where the inflection point in terms of scale will happen. Having said this, I also know, like we are, as I mentioned, small NBFC, but we do some extent of co-lending and I know many people of my size who are also into co-lending, though not technically qualified. It might be a BC model or it might be a 80-20 model, either ways. But co-lending is happening even at that level, and coming to my first point, what I mentioned, that this might not be counted in the 5,000 or 25,000 crore. Hence, I believe the opportunity already is much bigger. One, getting it categorized into a proper co-lending arrangement. Second, taking it to the next level. I think these were the two things which will eventually happen.
Understood. And again, very great news for the ecosystem. Let's now dig a little deeper into the co-lending ecosystem, right? And this might be a little technical for those who don't do co-lending, but since we have two experts on the panel, I thought we owe it to the audience to dig deeper. So CLM1 versus CLM2, right? And I don't know which one of you wants to go first, but if you could, if your preferences, your thoughts, what is the role of both of those?
See, currently in my knowledge, whatever I know, CLM2 is something which is much larger. Because CLM2 is actually, if you see, that's akin to a direct assignment. So we are very familiar with direct assignment. Direct assignment is happening, like for 2 decades I have been in banking. And from the day one itself, direct assignment was there. Of course, that has evolved over a period of time. And also technologically, CLM1 is easier to implement compared to a CLM1. But if you ask me what is the future lies in CLM1. As the technology evolves, because CLM1, we need a very quick decision making. Because in CLM2, we are basically reimbursing the amount because it's a securitization route, because it's a direct assignment route. CLM1, we need instant decisioning. Now, some of these products will require instant decisioning, like supposing for a gold loan or a personal loan. But some of these products can wait, like probably a home loan can wait. So it will all depend on what is the product which is chosen between the partners. Second is that what is the technological level of preparedness. So it's two systems, and today we're in an era where the IT security is one of the largest concerns. So both of them to come together, integrate, becomes little more challenging in CLM 1. But I'm quite sure with so many technological partners coming in, probably in 6 months or a year, that will be probably the more evolving model.
Right, interesting. Nilesh, while you answer that question, add-on question there. Do you think that, and this is something that I heard from a peer of yours, do you think that CLM1 might be better suited for smaller, quicker loans, and CLM2 might be more appropriate for large? Is that something you see?
Okay. For the benefit of audience, let me take 2 minutes just to make clear about the difference between CLM1 and 2. CLM1 is where you actually do a tech integration and you are doing disbursement parallelly. Two partners are doing disbursement parallelly to the customer. Whereas CLM2, you eventually partner A will disburse and then partner B will give the money to partner A. So that's just a technical aspect. Having said this, the definition itself says that CLM1 involves lots of challenges. It's technology integration, it's real time, credit decisioning has to happen parallelly at both places, as Naren mentioned rightfully. Okay, it will depend on which product you get into, will decide what model eventually sustains. Okay, one or two both have their advantages and disadvantages. As we talk today, people are trying to get into the CLM1 partnership more, trying. 2 is an easier one and it's something similar to DA, what Naren also mentioned, it's something similar to DA. So as a lender, we are used to that. But with 2 of my tech partners around, I think they are working and Kushal can speak a lot on this. There are tech stacks which are available where you can actually do tech integration. It's very, very difficult when you start. So your tech integration, your credit policies and all, it means you need to get into too much of detail. And we will talk about challenges when I don't want to pitch that at this stage. But I also want to assure that there are lots of solutions which are available. Kushal is here, he's working on it. I know a couple of more participants here who have good solutions available. If you have a solution, I believe CLM1 is a better model.
So perfect. So that's the correct segue for the two techies, right? What are the tech challenges that clearly Nilesh has said it's all your fault? So
definitely. Yeah, it is always.
I stand corrected, it's your solution.
Yeah. No, thanks for that. So I think between CLM1 and 2, 2 is something like a direct assignment as we talked. So there is already a bit of tech that is built and then that can be repurposed to meet the CLM2 requirements. But having said that, and I think the inquiries that I have seen personally working with some of our customers, it's coming up more on the CLM1. That's where, we see, we work with our partners, we being the tech platform on the LOS LMS side. So they want to partner with multiple NBFCs or the banks. So we work with our customers on the CLM1 in last few days that became like a trend that we see. Yes, definitely the integration is a big pain area. The data interportability is a big area. The repayment schedules is one of the complex subjects that we normally solve. That's how our platform actually grown in India. So there is a differences between the partner 1 to partner 2, how the repayments are there. So there are various tech challenges, but having said that, I think in last few days, the maturity has come in the platforms where we are able to integrate with the multiple partners into bringing them onto a single window, and then we are able to approve the case. So right now we see a trend in a LAP and home loan kind of a business because there is really not a very time crunch in approving the transaction. So I think the CLM1 model will work for some of these loans where there is a timing is there. There's a good amount of synergies are there in the credit decisions between them, and the loan can wait for a day or a 1.5 day for the credit decision. There the models will pick it up. But something like a gold loan, as the bankers are saying, it's very difficult to integrate that on a CLM1 model because the customer is actually sitting in front of you, and we have to approve the case. There's a tat of sending that customer out in, let's say, 5 minutes. So I think the CLM1 model for some of those will take some time. It will happen eventually, but right now I think the tech platforms or the integrations are the challenge in getting some of those instant decisions because these are more of a branch-led credit decisions products. And also on the digital PL kind of a product also on a CLM1 may not work. But there could be offline PL case which can be disbursed in 48 hours. Still the CLM1 can work because there's offline credit decision that's happening. So again, I think from a regulation perspective, there has to be a complete credit cycle that has to happen between both the partners on the CLM1. That's where the tech challenges come in. So there are some integrations that we have already done working with our customers. I think it's just a matter of time. CLM1 will grow for some set of products, and CLM2 anyway there as a module. This is what I personally seen working with our customers.
So Kushal, before you begin, and just to give you a little bit of spice here, clearly the two buyers have said tech is the problem, right? Let me give you the opportunity to repay the compliment. How difficult is it to integrate with their legacy systems, right? And why don't you, I mean, hopefully you won't hold it against Kushal for giving an honest answer, but let's hear, that must be a challenge of running the tech business.
I actually take 30 seconds before I hand it over. That's biggest challenge. So when we go to the bank, they'll say, I have existing LOS, LMS, I don't want to touch it, but I want to do co-lending. Right, it's very difficult to solve, right? So we end up actually working with them, making them to say, no, you should have a better platform. So because they'll say it's Excel file that will come in. So we can't manage CLM1 on Excel file. It's very difficult to do that kind of stuff, right? So we find it difficult, but at the same point in time, there are companies who are taking those tech decisions to revamp their platforms. So if you have to really go on to the CLM1 kind of a thing, I think the tech platforms have to be upgraded. Remaining on a old technology, I don't want to change my LOS, I don't want to change my LMS. I think it's really, or please integrate with my core banking, which is already tons of volume that is gone into the core with the UPI transactions. There's a change cycle that goes into the core banking to do the transaction. So there has to be openness from the bankers also or the IT teams in the banks to upgrade their platform so that our job of integration becomes easy.
Yeah. So if we talk about like CLM1 versus CLM2, right? So there are few, again, fundamental differences, and because the two different models also have different kind of challenges. Right? So if we look at a co-lending, so the life cycle is broadly three parts: origination, underwriting, and the accounting and reconciliation, right? So while the origination as well as the underwriting piece is more complex in CLM1, because there is the concurrent processes of happening between the two lenders, and there is an interlocking of each of these steps. That there is a step that NBFC is doing, the bank is doing, NBFC is doing, and then together the sanction disbursement is happening. And as it is a time-sensitive matter, because the borrower will not be waiting for 1 week for bank to take a decision under CLM1. So those are the certain specific challenges in CLM1, right? But certain things become easier because you have the common date of disbursement, and there are certain things become easy with respect to that. Under the CLM2 model, obviously when we look into the reconciliation, and I think that is something probably one of the most underappreciated problem or under-recognized problem, right? So there are a lot of challenges into the reconciliation because, and it just becomes a complexity at a different level because you have to have a system which is like a 3 LMS in one, which has to handle all the underwriting, all the accounting related logics of the NBFC. It has to handle all the accounting logics of the banks and the legacy systems which are there. And there has to be an integration with them where there's a seamless data flow, right? Because now here, the two lenders are working together and one loan book is partly into the NBFC LMS and partly into the bank CBS. And these two systems don't and can't talk to each other. So there's a very different kind of a tech challenge and a very unique challenge, which is for which practically there was no existing solution historically. And then the solution is needed where in one leg the solution can have a deeper integration to the bank and can replicate the banking logics. And on the other hand, it can have the integration to the originator and the NBFC and can replicate the NBFC logics. So those are all the challenges related to accounting, reconciliation. Underwriting is one piece, but what we have seen in the past experience that in the overall equation, probably 20% problem statement is origination and underwriting, and 80% is actually the management, because that is something that is for the entire tenure of the loan. The rate resets will happen, foreclosures will happen, part prepayment will happen. Each lender will have different ways of doing things. And there has to be one platform which can handle all of those scenarios. So it's actually quite complex that we have seen in itself. And actually from the banking integration perspective, actually we didn't feel that much of challenges because we kind of seen that where we were able to complete those integrations, if you're getting good support from the bank, if there are the tech API documentation in place, we are able to do it very swiftly. I think we have seen banks have become very, very efficient in helping the vendors because they're already working with multiple vendors. So I think there is certain stack which is in place where we are able to complete the integration in maybe 2 months, 3 months, right?
So Kushal has just won himself 3 new banking fans from the audience. But no, let's go back to Kushal and Raju, right, and focus a little bit more on the tech. We've heard what the tech stack is. We've heard the problems the buyers have. We've heard what your solutions and your problems are. What's the future? Where do you see the tech stack going? What are the new things that you're, subject to being able to publicly discuss it? What are the new things you're working on, which might interest the two gentlemen sitting right next to me?
Yeah, I'll go first. So I think there is a level of standardization that is required because that's something that is really missing in terms of the way the data is captured, in terms of the data that is being transferred. So I think as an industry, between the tech platforms and the banks and the other bodies, I think we should work on some kind of a data exchange platform, which is missing today. I think that's something that will definitely facilitate these relationships to flourish better, and the integrations can happen faster. Because today, while we would have worked with 2 partners, but getting a third partner onto the board, it becomes really difficult to translate the data. So we definitely expect that there has to be a body defining the entire standard way of communicating between the parties. I think that will definitely help.
Yeah. So from a tech perspective, I think over the last year, we have built a lot of tech. We've seen different kinds of problem statements for working with different lenders and different products, right? So the challenges for supply chain finance would be different than challenges for gold will be different than challenges for vehicle, right? So we have kind of built those kind of things, which it's about the agility of the platform, that how the tech is built and how the tech is to be evolved to continuously meet the needs of the co-lending, right? Because in co-lending, when typically we're working with a lender, the scope is much larger because a lender might choose to have one LOS LMS for one specific problem statement like retail, and they could have another LOS LMS for another problem. But when they typically go for a co-lending, the expectation is that one single platform is able to handle all the products. Right? So it is like one LOS LMS which is working for the 2 parties and handling the different products, right? So we had to support, for example, gold STP journeys where the loan is disbursed in 10 minutes in a real-time deciding for a CLM1. So it has the agility of the product that it can handle all kinds of loan products on one single platform and has those relevant API stack which can integrate with on one side with the lenders, the originator, and the other side with the bank. And there is no piecemeal solution which would work in co-lending, wherein if one solution provider is only helping for origination but not for underwriting, or only helping for origination and underwriting but not for the management, because otherwise it becomes a lot more challenging if the solution is not complete and if the solution is not 360-degree.
Right. Interesting. Fabulous. We're slowly running out of time. I'm tempted to ask a slightly tricky question. I'm not going to, because that should be the topic of another 1 hour. But on how, given that data is the oil that greases all of this, I'm tempted as a lawyer to ask how you think the new data law will impact your data sharing arrangements with multiple. I think we've got the right panel. Maybe we'll get you together next year at the BFS to ask that question. But before we move on then, to the 2 buyers / lenders / originators, where do you see the market going generally? I know, Nilesh, you're very enthusiastic. You think it's going to grow multiple times. But the question is, do you see a differentiation between CLM1, CLM2, securitization? Do you see certain parts of the market gravitating to one of these models? Do you see some parts of the market only sticking to one? Or do you think for the next 5 to 10 years there'll be a mix and match, and then, slowly as everything will solidify, we'll see some stability in the market? How do you see that?
Okay, I think tricky one. So you ensured a tricky one. I think in the near future, all 3 will coexist. And as Narendra also mentioned initially, co-lending is still at an evolving stage. So obviously there will be growth because the base is low It is bound to grow from here. It will eventually at a point go and stabilize, where I believe that there will be evolution of the models in 1 and 2, largely driven by the product type, because there are some requirements specifically in CLM1. Some products can suit more to CLM1 as far as today that we are seeing. How it evolves is something which we'll have to see. But if you ask me in today's perspective, CLM1 very clearly for a product with slightly higher TAT where you can take time for decisioning. CLM2 largely for a quick TAT product like gold loan PL that we talked of. Okay. Will it continue this way? My view is the answer lies to my extreme left, two panelists. If they get technology solution, I think the blur between 1 and 2 will get reduced and there will be an overlap between 1 and 2. Yes, to go to the securitization level, I think it will take some time. But I personally believe that co-lending is going to be the next future because it has lots of advantages. I think we have talked lots of challenges. I am sure we are discussing here, it very clearly proves that this model has lots of advantages to all three partners, be it customer, be it an NBFC and be it a bank. So in paucity of time, I am not getting into elaboration of the advantages, but it's a win-win for all three and hence this model is going to grow. Naren?
See, this technology problem is definitely there in co-lending, but that is probably overhyped. So besides technology problem, there is a problem in the risk assessment of both NBFC and the bank, and also the credit process, monitoring, NPA classification, and most importantly, the recovery. Who will recover, how it will be recovered, and once supposing you are given a home loan through co-lending, who will recover, and once it goes to court of law, who will be recovering under SARFAESI, and how it will be distributed, the cost and other things. So those things actually will evolve only when defaults start kicking in. And that probably will take a couple of years from now. So in my view, co-lending will grow definitely, but it will be still a much lesser subset compared to the securitization. Securitization probably this year will be around maybe 3 lakh crore or something. Even if it is going at 20-30% in a year, that will be still much bigger than co-lending, even if co-lending grows at maybe 40-50% in a year. Because in case of securitization, things are pretty well defined. It's proven, and banks also have their own internal processes, approval processes, learning, understanding, all are in place. So barring technology, as we evolve, we will also understand how to accept the NBFC risk and how to see that they actually bring far better reach and far better recovery method, and which is quite different from the way the banks are doing. As the banks and the NBFCs learn each other more, this would evolve. This might, in my view, will take another 3-4 years to come to that stage. Till that time, securitization will be much bigger than co-lending.
Well, thank you all of you. I think we are all out of time, so we'll have to wrap it up now. But thank you. And just to summarize what we've heard, from the buyers, we've heard that we're at the start of the journey, at least for co-lending. We're going to see a boom. And from the techies, we've heard that regardless of what the present day challenges are, they've got solutions up their sleeves. They're willing to bet their companies on those solutions. And so hopefully next year, when we do another round of session, maybe not the same speakers, maybe not me, but when we do a check on the state of the market next year, we'll see whether what Naren and Nilesh said have come true, but we'll also see whether Kushal and Raju have lived up to their promises. And on that note, thank you everyone for hearing us through. I hope it was interesting. If you have any questions, do approach the panelists, and I think they'll be around. They'll be happy to answer the questions. Thank you.
Thanks.
Thanks, everyone.
Thank you, everybody.
That was a very interesting session indeed. Gentlemen, can we just have a photograph, please? Thank you so much, panelists. Thank you so much, Mr. Chacko, for such a wonderful session.